Good afternoon. The Minister for Finance, Paschal Donohoe, delivers on Tuesday, the 13th of October next, one of the most challenging budgets in recent times, perhaps since the austerity budgets of Brian Lenihan back in late 2008 and 2009. Despite the position of the Minister that there will be no emergency provisions, this must be very much tempered against a backdrop of a budget deficit of almost 24 billion and the ongoing and troubled negotiations between the British and the EU governments around the Brexit negotiations up until the end of this year. Against this considerable and troubled background, a number of our team members have detailed out what we expect to see in this forthcoming budget.
Multinationals pay 77% of our annual corporation tax receipts. The government will want this important group to know that Ireland continues to be a stable and attractive place in which to operate. It will be confirmed in the budget that the Irish corporation tax rate of 12.5% will remain. In addition, there will be no immediate change to our interest deductibility rules. We will, however, have to make that change by 2024 under EU rules. Self-employed individuals may not feel as well looked after as the multinationals, with the expected 1% increase in PRSI, as they already have a top rate of 55% compared to 52% for employees. Otherwise, we expect to see improvements to the tax appeals process and extensions to the tax supports for businesses affected by the pandemic.
With regard to capital taxes, it is unlikely, despite earlier predictions to the contrary, that Budget 2021 will seek to increase revenue from CAT. With regard to capital gains tax, while Ireland has one of the highest CGT rates in the European Union, and the government's tax strategy paper in relation to Budget 2021 acknowledged that a decrease in the CGT rate could generate economic activity, it is now, we understand, unlikely that Budget 2021 will include any reduction in the headline CGT rate. With regard to stamp duty, Budget 2021 could see an increase in the rate of stamp duty on homes, where the purchase price for the residential property is in excess of £1 million. In addition, we could also see changes to the stamp duty refund scheme, which was introduced in Finance Act 2017 to encourage the construction of residential property.
With less than 80 days to Brexit, the budget has been framed on the assumption of no deal. We therefore expect that the budget will contain additional targeted business supports. On the VAT side, we expect that the Brexit Omnibus Bill will confirm the introduction of postponed accounting for import VAT, which will be a major cash flow saving for affected businesses. The government is also now expected to give some much needed support to the hospitality sector, with a cut in the rate of VAT from 13.5% to 9%. Finally, with time quickly running out, we strongly urge businesses to accelerate and finalise their preparation and contingency planning for Brexit.